In today's video, we are going to take a look at a company that has exponential growth potential for the next lot of years, and this company is Embraer. And the reason why we are taking a look at that, they are two major players in the aircraft making industry. One of them is being Boeing, and has it been suffering for the past few years, and then the other one is Airbus, and that has been growing, but now it's unable to service all of the customers due to the demand. And now we are going to look at the third company, the third biggest aircraft supplier, and this one is Embraer, located in Brazil. A huge growth potential, especially in the past few years. And I'm going to say that this company will be fast growing as well due to the defense spending increases, because this company does not only produce aircrafts for aviation, but also for defense. And also the compacts of small flyings is going to be reduced. So for example, they are producing an airliner that has only 2 and 2 seats, where other ones would produce 3 and 3 seats, which is much harder to fill. For example, in Europe, where this 2 and 2 seat composition is very good to service from smaller countries, from Hungary towards from Amsterdam, for example, with KLM, or like Austria just bought the jets. They can just pick the people up and then fly them to Vienna, and then from Vienna they can take their long haul flights. So there is a lot of opportunity, especially due that the airline industry is pushed into more environmental changes, especially in Europe, and also that there is sort of a macroeconomical situation where there is a high demand for flying, but a low amount of supply due to the supply chain shocks occurred from Boeing, and also the maintenances that can be an opportunity for this company. So if we look at how they make their money, we can see that they're 34% of their total revenue coming from commercial aviation, 27% is coming from executive aviation, which is private jets, all of these things that what rich people can afford, but I can't. And then there's service and support that are connected to these services, so obviously maintenance and all sort of this type of things. And then there's the defense and security, which is a growing potential, especially as Europe and the US has been increasing their defense spendings. This could be an opportunity for the company to grow. As I said previously, that for example, Airbus, who is a huge player in the European market, is not that much able to supply the fast need of defense and security elements. And we can see that their total net income percentage is 5.5%. So pretty good. They are profitable, they're growing, so there could be some possibilities. If we are looking at the stock price, you can buy the stock through eToro, for example. Down in the description you will find a link. If you don't want to open a real account, you can open a demo account. You can practice and learn how investing works through eToro. I highly advise. I am part of the eToro group. I am also investing through eToro, so I can recommend for long-term investing as well. So we can see that their current share price has grown a lot. In 1 year, 89%. This is due to the two things I have been mentioning previously. Many factors are playing into the picture of this company to be a growth potential. We can see that the price target is around 60. And let's get into the more reasonable, more amount of data, and let's find out through our Google Sheets, which you can also find through the description. Is this something super stable? What are the red flags? What are the green flags? What are the potential growth signals for the company? We can see that the current price to earnings ratio is about 24, so considerably high for a mechanical company. The current price is 57, so there's a little bit growth potential, and the dividends has been decreasing due to that. They would rather reinvest it into the company and make it more stable. There is a little bit of debt, but also they have a bunch of cash to finance the R&D, for example. But if we see their income statement, we can actually see that the growth amount that they have in the past 2 years is incredibly good. Even though they are not a direct competitor to Airbus or Boeing due to their smaller aircrafts. They can see some market potentials from the smaller aircrafts, and you can see that their net income has been growing rapidly and they are profitable for the last 2.5 years. So this is something good for a long-term investor, a good possibility, and the free cash flow amount of generation has been pretty nice for the past years. So you could make a discounted cash flow model based on these data, and we can also do that. We just let's check the analyst opinions. We can see that it's currently a very mixed picture. It's due to the recent growth. Most of the analysts are waiting in the 45 to 60 area. So currently the share price is overpriced due to the analyst ideas, but the reason for the high share price and the high growth is the possibility to have a future growth in the company. And overall, if you look at the ratios of the company, we can see that their price to earnings ratio for the past 3 years, 2.5 years has been relatively the same. Now it's a little bit growing, but as you can see, the price to free cash flow situation is about the same. It has a growth tendency due to the growth possibilities in the company. So overall, I think it's a good company. There are a lot of possibilities, especially that they are coming from a developing country. So internal markets can also be a great opportunity. And if you have any questions, feel free to drop it down in the comment section. I would love that if you could subscribe and help my YouTube channel growth. And also just drop down in the comment section what stocks you would like to get analyzed so we can put it in the next video. And see you in the next one. Goodbye.